How are you? So let us continue with the seasonal moves, market sentiment, and the 4 phases of focus. Now, seasonal moves. So we divide the year into 4 quarters, and we call them seasons. Basically, a quarter will contain 3 months. So right now, we are in the second quarter, May. So the dealer usually sets the trap moves, and he has specific time for setting these trap moves, and one of them is during seasonal changeovers. So we observe these seasonal traps using the daily time frame and the hour 4 time frame. So we learned on the natural support and resistance points, simply their previous highs and lows, and we learned on the stop hunting. Like stop hunting is a sharp move towards this natural support and resistance. So before the market swings, usually the dealer accumulates, and then we see a false move or a trap move, or we can call it a stop trade. And after the stop trade, there is where you see the market swinging in the anticipated direction, or a new direction will be established. So you would see that before any major move is made, a season move or a season shift, you see the market experiencing what is called loss of liquidity. So this is the time when you see the market consolidating, and after consolidation, you would see the market having a false move to take out traders or induce traders in the wrong position of the trend, and then after that you'd see the real seasonal trend, and that can clearly be observed in the daily time frame. So why should we know about this? Why should we learn the seasonal moves? There's a high probability of seeing big market shifts after every 3 months. So after every quarter. So we need to monitor the market during this period of time, and we need to include the COT and index analysis for conferences. Without understanding this, you're prone to trade within these consolidations, which will result into losses. Now, because usually market maker trend is not followed. Hence, you won't be able to see levels, especially the safety trade. The safety trade will not be working during that time. You'll see the market buying today, selling tomorrow. So basically, what we believe in is not followed. And market makers will test your patience, and that need to for you to trade within these seasonal consolidations. And you'd see them giving you patterns, clear patterns for you to enter, and then you'd find them having a stop hunt. And then after the seasonal trap is made, they establish the direction they need. So we need to observe several charts here. We have USD ZAR, we have GBP USD, Euro Yen. So this is USD ZAR chart, and it's simply a reminder of what we learned on the peak resets, basically the daily time frame. So we go simply deep in the daily time frame. So this is where the year started. So this was beginning of the year, and I think here is the beginning. 1, 2, 3. No, this is the beginning of the year. So we had our low of the year set around the blueberry, and you can see this shift occurred almost immediately. Like we only had railroad tracks, and then the market did shift. This is because we had the 800 EMA here. So basically, we learned that this exponential moving averages, which has higher periods in the higher time frame, they're used as moving support and resistance points. So basically, we would see a shift as a reversal around the blueberry. So this is where the dealer set the low of the year. Basically, January was here. So this was the high for January, and this was the low for January, but also the low of year. After this shift, we see clear 3 levels going up, and the market now had to reverse. Before reversing, we had like a 5 days consolidation, and you can see the market having these pins going on the upside for a liquidity grab. So this was a liquidity pool area in the hour and time frame. And then we had this reversal here, but then the market came and reversed around this mile. And then you see the market had this trend up to the initial high of the year. And this was now the end of the first quarter. So you'll see before having the shift, we had like this deep consolidation. So this is the time when you see on the hour, the market is chopping both ways. And you see before having the shift, the market did have this false move. So this was the false move against this trend. So after this false move, we see the market had this trend. And again, the market did bounce around the 200 EMA. So you can see the significance of these EMAs with higher periods in higher time frame. And then after having this consolidation here, so this was like a 6 days or 8 days consolidation, and then we had these 3 levels going up with the market taking out these highs. So basically, the market makers had the liquidity they need to shift the market, and we had this very good shift going down. So at the beginning of the third quarter here, we had this consolidation. So this was around 2 weeks of consolidation. And after this consolidation, we had this bigger shift. And this sharp move, you'll see the market moved really sharp. The sharp move went all the way towards the high of the previous year. So this area here, back there, we had the high of 2018. So the market went all the way to the high of previous year. And you can see when it reached around that area, we had like a 3 week consolidation. So this was a very deep consolidation. So in the hour, and the market was very choppy. So it was during this time when you see that safety trades on the hour and are not working. The market will give you like a peak reset here, but it's not really a peak reset, but only the market having this range. And after establishing now the high of 2019, we had this shift, and this marked the end of the end of the year for December. So this is GBP USD. So the difference on our USD ZAR and GBP USD and other pairs is that we had this market crash. Like here we had this gap was around 250 pips, and this pin was around 500 pips. So this was like a 750 pips stop and so basically a market crash to trap liquidity, break of this initial high that was formed, initial high of the year. So it was basically a liquidity grab, and market did reverse. And from there, I think the market made a peak here, and then we had a very good downtrend from there. So basically, if you look into these graphs, we have observed that there are times in the year when we have consolidations. The dealer accumulates before having a shift. And at times like this, top range is usually both ways. and the Seiko in hour and time frame is not followed. So the market maker trend is not followed. So during this time, you would even question yourself if at all what you're doing, what you believe in is working. And usually ADR is reduced to minimum. Like you would find Euro USD having the average daily range of maybe 40 pips. And in the 15 minutes time frame, the period setup is usually not followed. And stop-ins are usually deep when the dealer reaches these previous lows or previous highs, like lows of previous months or years. And then after having the seasonal consolidation, we observed that we saw that after the market have a consolidation, we have what we call a seasonal shift. And before the dealer shifts, usually the dealer offers a false move, usually 1 week false move. Then you find the market shifting direction. News is used to perpetuate the move, and after the shift, 3 good levels are seen on the hour and time frame. Usually three good levels are seen on the daily time frame. Usually on the hour one is you would observe several peak resets. Always trade in line with this trend. And several peak resets, that means the minimum will be 3 peak resets and so on. So sometimes you'll see up to 4 peak resets or 5 peak resets. And during this time, you would find weak stop-ins as the dealer moves from one level to the next. ADR value will increase to the maximum. During this time, you'll find the ADR is at the maximum. We also observed the exponential moving averages. Like 5 and 13 crossover indicates a start of a shift, and this is on the daily time frame. A pin to the 13 EMA on the daily is a peak reset on the hour. A pin to the 5 EMA usually is a continuation of a trend. It can be a peak extension, price extension, or a quick reset on the hour. And a pullback to the 50 EMA is usually a safety on the daily. A pin to 13 and 50 is a solid peak reset. This exponential moving averages with higher periods, like the 200, the 800, and the one with 3,200. See, when price bounces around the CMAs, it usually indicates a reversal. So we have observed those, and we'll be observing them as the market continues swinging, going up or going down.
Sorry.
Yes.
So everything you just said now is on the 1 hour time frame.
On the daily.
Daily time frame. Okay.
So basically, we have dig deep into the daily time frame, and you see, having the knowledge of seasonal moves simply means that during the strap moves, you simply observe using the disparity. Like we had the strap moves in the previous around 3 weeks or 2 weeks on the card pairs. The card pairs were very choppy. I think up to today, they're very choppy. Even sometimes for the Audi pairs, the yens and the cards. So having known that, you simply know how to trade these pairs that are within a range. Like you need to be careful with them. So let us learn on the market sentiment, and then we come to do analysis. So basically, market sentiment can be defined as the general prevailing attitude of investors as to anticipated price development in the market. So it's like the market feeling of traders traders who are participating in the market. So each and every trader will have their own explanation as to why the market is moving in a certain way. And traders express their views in whatever trade it takes. So you would basically see the market feeling, this combined market feeling, by using the order books that are available for us. So you simply see that most traders see that maybe Euro USD is going up. Most traders see that the dollar is going down. So as a trader, you need to get this market feeling, and this is what we call sentiment analysis. So the order books that we can get access to are the brokers retail clients order book, and we also have the COT data, the commitment of traders report. So I on the brokers retail order books, I've taken an example of the Oanda order book, which is a 24-hour summary of open orders and position of Oanda clients. So you would see, like here we have open orders and this is open positions. So basically these are pendings, orders that are not filled yet, and these are running orders. So these are orders that have already been filled. So basically at each price levels, you can see the number of orders that are in. So Wanda basically is a Forex broker, and so you will only see a segment of orders of traders in the world. And retail orders in the hand do not move the market. So I find it less helpful for us. Basically, we will not be using it, but it's important to know that this kind of thing exists. And now let's talk of the COT report, the Commitment of Traders report. So the COT is issued by the CFTC, which is the Commodities and Futures Trading Commission, and it reports all open positions in future markets for three main group of traders. We have the commercial traders, which are basically the hedgers or the producers, and the non-commercials, who are the large speculators, the money managers, or we can call them the consumers. And we have the non-reportable, which is the retail market. The COT report is issued every Friday, but it includes data from Tuesday to Tuesday. So 3 days data, which is prior to the release date, are not included in the COT. So who qualifies now to be reported by the CFTC? For you to be qualified, you have to carry out a lot of trading. So you have to carry out a lot of trading for CFTC to consider to report you. So these guys who are reported basically carry out a lot of trading. Their smallest contract they are allowed to trade is 125,000 euros. So we have important definitions that we need to first understand before we come to the analysis part. The first one is the open interest. The open interest can be defined as the total number of outstanding contracts that are held by market participants at the end of each day. So in order for a contract to be a contract, there has to be one buyer and one seller maybe opening a position. Therefore, you will find open interest increasing by one contract, or one old buyer and one old seller, they are closing their position. Then you'd find one contract is decreased, then open interest will decrease by one contract. So increasing open interest simply means new money is flowing into the marketplace, and that would imply that traders are creating new transactions, they're opening new positions, and the result will be the present trend will continue. So increasing open interest on a bull market simply means the bull market is supported, and increasing open interest on a bear market simply means the bear market is supported, and vice versa. So declining open interest simply means the market is liquidating, and it implies that the prevailing price trend is coming to an end. So the number of traders is not infinite. Like we have a finite number of traders. So basically, the open interest has to have like a multi-year maximum. So the maximum number of traders. So if open interest is at a multi-year maximum, it simply means that there might be very few traders left to transact. That means liquidity is gone, and the prevailing the prevailing trend should come to an end, because there is no liquidity to support the move going up or going down. So declining, if open interest is at a multi-year maximum, the current trend might be near to its end, as there might not be many traders left to transact. They are all in the position already. We also have now the commercial traders. On the commercial traders, these are the hedgers in the financial markets, and in the commodities markets, these are basically the producers. So gold mine, sugar factory, which producers do. So these are the commercial traders. So in the financial markets, these are hedgers, the financial institution that hedge against future price changes, and they hedge so as to minimize the risk of loss against future price changes. So they basically stay on the other side of the trade. Like if the market is buying, they'll be selling. If the market is selling, they'll be buying. So they're basically on the other side of the trend. We also have the non-commercial traders. These are the large speculators, or we can call them the consumers. So in the commodities market, they're called the consumers. In the in the financial markets, these are simply the large speculators or money managers. So the main objective of a speculator is to generate profit from the difference between the current and future prices. So they provide high market liquidity. So large banks, investment and hedge funds. So you'd find investment banks, hedge funds, all of them, they're included in this section. Basically, money managers. So these guys manage money for their clients and are highly profit driven. They are trend followers. So they will be bullish in a bull market. They will be bearish in a bear market. And whoever now is left after classification goes to the non-reportable group. So this includes small retail traders like me and you. So basically, retail open positions don't move the market, and simply in our analysis, we would see that we only follow the large speculators as they go along with the trend. So we can analyze the COT by using the graphs or the numbers. So by using the graphs, here we have a net position for the commercials. The red line is for commercials, large speculators goes with the green, and we have the small traders here, the blue line. So basically, when the commercials are buying, so this simply means they're buying, and these are the number of orders that are in. It simply means the market is selling. The non-commercials or the large speculators are selling. And we have seen this is the open interest. And if you look at it, this is like the multi-year maximum. So at this area here, so you've seen that as the market was bearish, it reached a point when open interest was at multi-year maximum, and also the market now was reversing. So at this point, the market started reversing. And then we had an increase in open interest as the market did buy to this point, and then we had the market selling. As the market was selling, also the open interest was increasing. So the bear market was supported, and then eventually it reached that multi-year maximum again. And this is where price was reversing. And then we had the market buying again. So that's how we use the lines. But usually, personally, I use the numbers, and this is how you'd find it on the CFTC website. So this is British pound sterling for CME, Chicago Mercantile Exchange. Future only positions as on of 24th of March, year 2020. So we also have changes from 17th of March 2020. We have the non-commercials, we have the commercials, we have the non-reportable. So number of contracts for longs, for shorts, longs, shorts, longs, short. So we have the open interest and changes in open interest. And here we can see the open interest is around this number and the change is negative. This simply means market has liquidated. And if you look at it, for the number of longs, there are around 10,000 contracts that were closed around this time. But then these large speculators did not add the number of shorts. So basically, the market was simply consolidating. So they were liquidating for the next move going up. There is no trend change here. So at least if we would have seen that the number of shorts have also increased, then that could, could imply that there might be a change in trend. So we have this. This is the CFTC. The COT data. So I've made this Excel. So every week I usually feed in data from the website. So it was from May last year. And this graph is for the open interest. You can see the open interest right now, it's around the multi-year maximum. And this is for the CAD, Canadian dollar. They are extremely net long. And we look at net positions for the large speculators on the non-commercials. So the number of longs minus the number of shorts gives us the net positions. Okay, what the fuck is that? Okay. So we look at the net position balance for the large speculators or the non-commercials. So the difference between the longs and shorts gives us the net position balance. So here we have like 82,000 contracts versus 35K contracts. So the difference gives us net long. So basically Canadian dollar right now is net long. So we have the Swiss franc, pounds, JPY, so euros. So basically every week we would feed in data from the CFTC website. So the COT report is not designed as a market entry tool. It's simply designed to gauge supply and demand of important market participants, to gauge the market feeling, to gauge the market sentiment. So it is used to confirm mid or long-term fundamental bias in the given market. So basically, when we analyze the market, we usually combine the market structure based on the weekly and monthly time frame with the COT data. Does it match with the COT data? So usually look at that. So we basically when we do our analysis, we look at the market structure and then come back to the market flow. So sometimes the market flow may go against the COT data because it's a short-term bias. it's good for us as day traders and swing traders. So just going now to the 4 phases of focus. All well-thought signature trades have 4 phases of focus. We have the before entry phase, the entry phase, the reversal, and the take profit phase. Now, on the before entry phase, this is the analysis phase. So it's not a simple thing to correctly predict the next move in any market. And trading the FX market can be even trickier than trading other markets because it's a code-driven market. We basically analyze the charts. So it goes beyond wild guesses, intuition, or rash decisions. So we analyze price charts and forecast future price movements, and basically we also choose the most suitable currency pair to trade. And as MQP traders, we have taken one step further and consider every possible factor which has the tendency to affect Forex rates or the FX rates. So what do we look for in price during analysis? So we look for higher time frame manipulation. Basically, on the monthly and the weekly time frame, we look for the market structure, and we also combine it with the COT. And on the daily now and the hour 4 time frame, we come to look at the market flow. Also, we consider the exponential moving averages, and then in the hour 4 time frame, we look for if there is only a harmonic pattern, and we also look at the TDI. What does the TDI tell us? On the hour 1 now, we come to look at the market maker cycle, the levels, the ADR, and also the quarter points. So basically, those are the things that we look for in the market. So let us have a quick analysis. So this is Euro USD.
Hello?
Hello, still here.
Okay. Your screen is frozen, eh?
I know.
Okay.
Okay, so the monthly time frame. So I basically use the line chart on the monthly time frame, and here is where I look at the areas of support and resistance that are near the current price. So the current market price is at this level. We have a resistance just above it. And here we have another resistance area, and we have a support just below it. And then I look at order blocks, and there is no significant order block here. Then I go to the weekly now. And on the weekly time frame, I would see that at this area here, at this price level, we had an order block. So we had the last green candle before reversal, and price bounced around this order block. So we had a bearish market structure, but then it came around the blueberry and formed a reversal there. And now we are having a bullish market structure, and price has now come to this area of resistance. So we need to see a reaction around this area of resistance. If at all it shows a reaction that we are still going, we're going to reverse, then we'll reverse the market. But for now, we are still in a bullish market structure. So on the daily time frame, we come to look on the market flow. So we had like price was here, and we had price moving 3 levels going up, and then it came to bounce to this area here. If you look at it, we had like a W formation at this level, and then we had 1, 2. So we are basically on the second level going up, and if at all price remains sustained around this area and forms a strong resistance, then we would have a downtrend. So right now, you can see prices ranging around this area here. But since we have no reaction that the market would go down, we will simply anticipate for a move going up still to break this area until the weekly time frame gives us a bearish, maybe a bearish fractal, showing that the market will swing going. The market will swing going down. So basically here we had our peak formation. We had this area where we have another shark fin around the midline, and this simply indicates a peak reset. So a peak reversal and a peak reset here. So on the hour one, peak reset is around this 200 EMA, and it is seen that price has bounced around the 200 EMA, but then the candle close for today, I mean, for the daily time frame, price hasn't exactly reached this level here. So when this occurs, usually price comes back down to this level, and then you would see the market going up. So for now, see, I saw like a trade today on Euro USD, this one, the ID50. But because of this scenario where on the daily it did not exactly touch this 13 EMA, and on the hour one it's like having a peak reset already. So these two scenarios did not give me confidence to enter this buy trade. So I would simply wait for the market to fall to this area and then go up. If at all it gives us a pin on the 13 EMA. But if at all it breaks this, then you would find the market falling to the next area of support. I need to analyze I need a very different pair, maybe pound NZD. So this is GBP NZD. So this is the monthly time frame, and we are looking at areas of support. So we're having an area of support down here and areas of resistance. And then we look at order blocks. So we have an order block right here. So this is an order block, and then price reverse direction. So this line is around the order block. And then we had, this has returned to the order block, and then price went down. And right at this area, we also had an order block. So this was a bounce around the order block. And price here came and we had this bounce to the next area of support down here. And then right now we see an uptrend. So let's go to the weekly. On the weekly, we see market formed a very strong area of support here. So equal lows, and then we had a bullish market structure, came all the way to this area. We also had another block on the weekly. So this was a return to the order block, came down back, came again down here. So our order block down here is this one, and it did not touch this order block. So it's only bounced around this area of support. And right now, it's at this area of resistance. And you can see this is the beginning of the week, showing signs of reversing. But I wouldn't judge that with the beginning of the week. Huh? So on the daily, if you look at it, this is like a peak on the daily. So 3 hits to the bottom, and then we had level 1, a retest on this 13 EMA. So a peak reset to level 2, and it has reached this area of resistance right there. And this is why today we had this, and even the quarter, we had a large quarter point at this area. We had a very beautiful ID50 trade right here. So basically, peak reset was right here, and we have 1, 2, 3, and then we are having a peak formation high at this area. So our second level is still, we still have a downtrend to 13 EMA. So 13 EMA is 13 EMA is right here. So let's go to the hour one. So on the hour one is around this small quarter. Let's draw the ADR boxes and see where 1.5 ADR is. So ADR is 159. So it's there. So you can see 1.5 ADR is around this point. Huh? So price might reverse around the undershoot area here. So the undershoot is 25 pips from this. We have the undershoot area here. So you would see price coming back to this level here, where we'll be having a safety. And then anticipate for this move there. Okay, so I guess if you watch the analysis I sent today, you would get more analysis, because I basically had almost all pairs analyzed. So you would see from the analysis, someone is calling me. So you would go through the videos on YouTube, okay, and look on other analysis, but the tool will give you like an overview of how we analyze. And basically, we can have analysis maybe every weekend for the next month, okay. And right now, you can also be doing your own analysis, and you send them to me so that I can correct you, okay, if at all wrong, or I can confirm. So after doing your anticipation, we come to our second, our entry phase, okay? So on the entry phase, what do we look for in the entry phase? So on the entry phase, we look at the 15 minutes manipulation. So here we're basically looking at the the period setup. So is the Asian box below maybe below 50 pips? As the stop hunt been done as we anticipated? And do we see 3 swipes to the high or 3 swipes to the low? As the London pattern presented itself, like do we see an M or a W or a V, an 8 per 22 pattern? So after the London pattern has presented itself, we wait for the entry confirmation, the 5 and 13 crossover. So after entry confirmation, the timing is usually London session or New York session. And basically during the gap times, it's usually very good time, or 2 hours after gap time, 2 to 3 hours after gap time. So usually it's very good time to take trades. Always trade in line with the peak. If the peak is high, look for sells. If the peak is low, look for buys. So our stop loss, you need to be using stop loss, okay? On every trade that you take, you need to be using stop loss. And my normal stop loss is usually 27 pips. That's my normal SL. So we learned several trades, like this was a peak trade around the blue tracer. And we had an ID50 trade here, 50 crossover, and this was the pullback towards the 50 MA, and it gave us a pattern to trade away from the peak. Now we have a safety trade. So this was another example of a safety trade. The stop hunt started from previous day, and then we had a very big pattern around the 200 EMA. Price moved away from it. We have a blueberry trade right here, a break and a retest around the blueberry. We have a EMA combo trade. We have, this is around 800 EMA, so it was a peak reset for a downtrend. So on the hour one, this will be like a very big M around the 200 EMA. And we also have a peak reset here on Euro JPY for an uptrend. Another ID50 and a 50-50 bounce trade. And here we had a bullish order block, and then price returned to this order block, formed a pattern, and then we had an uptrend. We had a bearish order block right here. Price returned to this order block, and then we had a downtrend from there. We had a breaker block here. Price returned to this order block, and then we had a downtrend. Also had a last step broken scenario. Let us load the pound shift. I expected for pound shift to return to a broker block. So if you look at pound shift, we have a breaker block around this area. And right now, price is around that point here. And you can see we had this downtrend, and I expected for price to come and return here. So if at all it gives us a pattern to trade away from the peak, then we'll be going down. The peak was here. The peak was from here, and it hasn't completed the 3 times ADR. So we have other entries like the station zone entry, the large quarter point entries, the half point entries. We have the equilibrium, premium, and discount market entries. These entries are usually supported with other conferences since we are looking at indicators. And these are mathematical calculated indicators. We are not really sure if price will interact effectively with the indicators unless other conferences are available. So in order for us to take these entries along the market maker trend, we would have to look for other conferences that support our analysis. So after taking your trade, we have the reversal phase now. Market makers may fake a reversal to shake your emotion to get you out of a good trade. You need to trust the process, know that which is a reversal, which is a fake one. We have learned on the 3 intraday levels, we have learned on the 3 market maker cycle level. So you need to trust the process that the market would follow what we have learned. And on the take profit phase, always have an exit strategy. And the common take profit levels that I use are the ADR levels. I have the blue tracer, especially on gold trades, the quarter prices, also the exponential moving averages. Also, take profit depends on area of entry. So if at all you have entered your trade late, then your TP would be a few pips than the one that have entered the trade early. And if you have taken a peak trade, you have to swing it. And if you swing in 3 levels, then you can trail your stop well when you're swinging. After completion of 1 times ADR, there is where you can trail your stop. So basically, you need to master these 4 phases of focus and not concentrating only on the entry phase. You need to master all 4 phases of focus, and we have certain rules here. So rules to profit: 4 phases of focus should be mastered. Mark up your charts every day. Anticipate stop and zone and entry zone and day before it happens. It's very important so that when it's happening, you need to be there to take a trade. Show up to the market every day. No setup, no trade. Only trade when the dealer has hit the stops. So we only trade after the stop hunt. And learn to be highly selective. So I've taught you of very few trades. Some of the students will be looking for other kind of trades, like they are simply taking a trade because maybe the market cycle is telling them it's an uptrend. So when they see a certain bounce that is not of the trades that we have learned, and they simply want to take it, that's not being selective. You need to be highly selective with the trades that we take. And if price has at all moved, don't chase it. So don't chase a trade. Trade on the basis of a closed candle, preferably with multiple confirmations. So you need to wait for the candle to close in order for you to take a trade. And rather than aiming to make many pips per day in order to achieve your income targets, use a method which is highly reliable. Ramp up your contract size, take a few pips, and book your profit. Always control your fear, control your greed, know your account size, use a proper lot size, and do not use your phone in doing your analysis. You can take entries, but doing your analysis, you see the charts that we use in the MT4 and the PC have the templates, and all the confluences, all the factors that we have learned are within the template. So when you analyze using your phone, you won't see everything. So I urge you to be using your PC to do your analysis. And always remember, it's okay to have losses. As long as more of your trades are in the money than out of the money, then you're good. You're good. So that's all I have for today. Do you have any questions so far?
So this COT report.
Yes.
Can we, I'm just trying to. How do you? So one, where is that information from, and how do you piece it all together?
So
in the analysis when you're analyzing, because it's one of those things that's considered, right? So how does one factor it into your analysis? Hello?
Hello. Okay, so where do we get the COT data? So from the book, I've included two links. So the first link goes to the numbers, and the second link goes to the one for the insider week goes to the graphs. So there is where you can get the data. Okay.
Yeah.
And how do we include it? You see, the first thing that I usually do is feed in the COT data in the COT report. So after knowing that maybe euros are net long, NZD is net short, AUD is net short, then I go do analysis on the indices, the index for the currency pairs. So that's the first analysis that I usually do. So I combine what we have on the COT data with what I see on the monthly and the weekly time frame, and that's it. So if at all the weekly time frame is, or the monthly time frame is at an area of support or an area of resistance, like what we have seen on the pairs that we have marked today, then from there I would wait for a reaction there and the next COT data, so that to confirm if at all price has reversed or price will continue up. Because COT data is it's past data. Okay, so we don't know what really they are trading today, what the large speculators have been opening, have been entering the trades today, or have been closing the trades today. So we're not really sure. So I think that's how I combine them. And if at all you will be following the COT data, if at all you'll be feeding in the data in the Excel every week, you will note if there's any change. So you'll note if at all you find maybe in pounds they have decreased the number of longs or they have decreased the number of shorts. And if you at all you have been trading pounds for the last week, then you simply get the reason of why maybe a certain move occurred, and you would simply anticipate for the next move. So you need to be following it. Like, it's not every week that the COT data would be included in your analysis, but there are those weeks that you would see big changes. Okay?
Yeah.
So basically that's how I analyze. That's why I have the Excel sheet, okay, so that I could feed in data every week. And when I see big changes, I usually alert students on the group. Like you should not maybe pounds data on this week and that, or if the open interest has declined, so you should expect for the volatility to be low. There are those changes, huh?
Yeah.
Okay. Any other question?
No, that's it. So I guess I'll go and start marking my charts.
Okay, that's good. That's good. So should I send you this video?
Yes,
Because
please.
okay. So have a good night. We'll keep on communicating on Telegram.
Of course.
Okay.
All right. Thank you.